Bonds are simply a loan that companies or governments take out via financial markets. The buyer of the bond, it could be you, me, an investment company or financial institution, is effectively lending their money to them for a fixed period of time. While the bond buyers wait for their capital to be returned, they are paid a level of interest known as the coupon. Provided the institution doesn't go bust, the amount borrowed is returned to the investor at a specified time in the future. This is known as the redemption date or maturity date. Bonds are used to raise money. A company may be looking to expand, while a government could be funding public services. The UK government bonds are also known as gilts. A bond's yield is the annual return that the bond owner will expect to receive as an income over the next 12 months. There's a simple calculation to figure it out. Yield equals coupon divided by price times 100. Each new bond is issued at a set price called the face value or par value. If a new bond has a face value of £1,000 and pays out £50 a year, then the yield is 5%. This yield is the annual return an investor can expect if the bond is held to maturity. Because bonds are traded by investors, the price will change. That means the yield will change too. Bond prices and bond yields have an inverse relationship. So if the bond price goes down, the yield goes up, and vice versa. Some investors prefer to let professional fund managers pick individual bonds for them. As well as aiming to deliver income to investors, bond fund managers also attempt to buy bonds that might rise in price, therefore increasing an investor's capital as well. But not all bonds are the same. The higher the risk of a bond, the higher its yield will tend to be. This is compensation for the extra risk that the investor is taking. Bonds from governments like the United States, Germany and Britain are considered ultra safe. But bonds issued by some emerging market governments, such as Argentina or Turkey, carry much higher risk that investors may not get their money back. This is known as a default. It's why emerging market bonds typically offer higher yields. The same is true of companies. A bond from Apple, for example, would be expected to yield less than a bond from a more speculative startup company, as the risk is considered much lower. The riskiest part of the corporate bond market is known as high yield or junk bonds. The safest is referred to as investment grade. The lifespan of a bond, its length of time to maturity, also affects its risk and therefore yield. The longer the lifespan of the bond, the higher the yield will tend to be. Bonds are important to investors because they can provide a fixed income from the coupon payments with a yield that will likely be higher than what they can achieve on cash, whether in a savings account, a money market fund, or elsewhere. Generating a steady return is important for investors wanting to build a balanced portfolio. The other key benefit of bonds is that because they are viewed as safer investments than stocks and shares, they tend to increase in value when events rock the stock market and worry investors. This is one of the reasons that a so-called 60-40 portfolio of shares to bonds, that is 60% in shares and 40% in bonds, is less volatile than investing 100% of your portfolio in shares. Beware though, it doesn't always work out like this. In 2022, bonds fell at the same time as shares because of an unusual occurrence where interest rates were increased to control inflation despite a slowdown in economic growth. You can find out more about investing in bonds on the II website.